Welcome back to this second hour, today's edition of Butler on Business. Joining us now is David Morgan. David Morgan has the Morgan Report. David is our silver expert. He's silver in particular, precious metals in general. David, what sparked today's equity rally, and it also seemed to have a positive impact on the prices of gold and silver, was the apparent appointment, soon to be announced, of Janet Yellen to head the Federal Reserve, and she is, by all accounts, a major league inflationist. Do you think that's, in fact, what sparked the rally today?
I do, and I agree. I think of all the potential chosen few from the short list that the president's given to pick, Janet Yellen, I think, is probably the most dovish meaning that she's probably the greatest inflationist. Summers bowed out, as your listeners probably know, and I don't think he would have got appointed anyway. I think he's too unpopular. So, yeah, it's going to be very good for those that want easy money policy. She'll probably be easier than Bernanke, and we're going to see higher inflation down the road.
David, this past weekend, I was with some 20-somethings, and today a common hourly rate for a 20-something is $12 an hour. And I was taking the purchasing power of a U.S. dollar, or what you refer to as a Federal Reserve monetary unit, and tied that to the price of silver on January 1st, 1987, when silver was $5.50 an ounce. And it staggered them, and me as well, to say that a person making $12 in 1987, that in today's monetary units would translate into $106,080 in purchasing power. Now, they're only getting $24,960 in these inflated away Federal Reserve monetary units, but that same purchasing power in 1987, $106,000. That is just a staggering thought, isn't it?
It is indeed. And I'd like to just comment on that. I mean, I remember in my 20s when I thought I could hit $10 an hour, I thought that, man, that would just be just unbelievable, a wage rate that high. And, of course, as inflation is insidious, it's pervasive, it continues, it's ubiquitous, it goes everywhere, it affects everyone, and it continues. This is what takes place. You know, you go out 30, 40 years, and all of a sudden this is the number is a bigger number, but it doesn't purchase as much. I'd like to comment back on something I put up on the Twitter feed just before the show, Alan. Of course, I put up our show, as I always do. But it was a very brief set of charts. It's put on one of the most visited websites dealing with these matters, and that's ZeroHedge, zerohedge.com. And just a couple of graphs, the best and worst performing assets since Lehman Brothers. And so it's that time frame, again, like what you're doing. So if you go back and look from Lehman Brothers till now, even though the gold and silver markets move up and down, all markets move up and down, stock markets, commodity markets, precious metals markets. But on balance, from that time till now, the best performing asset of all assets that they looked at, which is primarily stock markets, currencies, were silver number one, gold number two. Worst, of course, were Greek bonds. In local currency terms, again, gold and silver were the highest rated. So let me just restate this slightly because I'm looking at it a little closer. Basically what they did is they took all the currencies and gold and silver outperformed every one of them. So something to keep in mind. It's good to keep the long-term view. I know people are upset that they've been in the metals markets maybe the last couple of years and the prices, paper terms, are lower, and I understand that. But if you started like in 2000, 2001, 2002, 2003, 2004, silver's at 23 right now, 22 rather. On the way up, if you bought it at 5, 6, 7, 10, 12, 14, and it got to 22, you'd be happy. But once you buy it beyond that point and it comes down, you're unhappy. And I understand that. But the point is that the metals, from the longer-term perspective. Last thing, I really think that we're probably have hit the bottom that we've talked about almost every show in the last 5 or 6 we've done, Alan, and we're probably going to back and fill and test. We're not going to test 18 in my view. I don't think we're even going to hit 20, although I don't rule 20 coming out, and we're going to be higher by the end of the year. And the time to get in the metals is when you don't want, when you're scared, like right now. Now's a good time.
Well, I would think, given the plight of our middle class and this $12 an hour figure, that, that would be something more than just fellas like you and I in shows similar to mine would discuss. I mean, because you're 25, 26 years old, making $12 an hour. Back in 1987, when I was that age, today I would have to make $106,000 to enjoy the same level of purchasing power, and it's staggering that it's never really mentioned.
I agree. I don't know if it's deliberate or not, but people of everyone, including yours truly, is kind of ADD these days. And the reason I say that is the internet is so fast and there's so much out there that you go to a website unless you see what you want within the 20-second time frame or a very short time frame, and the attention isn't focused on like historical fact, long-term viewpoints, and that type of thing. Even the stock guys are focused on quarterly earnings, which is only a 3-month time frame. And there's no juice in gold and silver for Wall Street. It's all about stocks and bonds. It's all about the paper pushers. So there's really nothing there for a mainstream financial show to mention anything about it. But people that are willing to think on their own, study on their own, and educate themselves, it's very apparent that if you don't have precious metals, you're really going to lose out in the long term. In fact, there's a study done. I'll be doing a webinar with some of the top financial guys. I think Peter Schiff is one of the better knowns. Peter's going to be on that program as well as myself and many others. And we're going to be talking about, or I will be talking about, this Ibbotson study that was out of Chicago. And it was a study on what is the best performance for a portfolio. How do you weight it? Do you weight it in bonds? Do you weight it in stocks? Do you weight it in foreign currencies? How do you do it? Well, what they found out, this is a totally objective, no dog in the fight, what is the truth, that you need about a 15% exposure to precious metals in all economic conditions. And that's metal. That's gold and silver coins you put in your hand. And this was a fascinating study because I didn't know that. I don't think they knew it until they did the study. So it doesn't matter if you've got, people like me that think that the economy really isn't recovering and that this paper money monster is eventually going to bite us really hard. If you agree with that view or you don't, doesn't matter. In this study, it says regardless of what the economic conditions are, you need to have precious metals in your portfolio. But you never, ever, ever hear that. And that's why I think the mainstream financial planners are in for a big, big problem. Because when this thing does unwind, people that have large portfolios or even modest portfolios that have paid a financial planner, they paid them to put them in the right asset classes, and they read this study and they find out that they had no exposure to precious metals, none. I would go into court and say, what the heck's going on? Here's a study. Don't you read? Don't you do your job? You never put me in the precious metals. This whole thing came down. If I had a 15% allocation to gold and silver, I'd be doing quite well right now. So this is something it's one of my soapboxes I'd love to get on, and I did a couple of these mainstream financial planning outfits and said, this really needs to get out. Don't you want to protect people? And they're such lemmings. They all follow each other. No one has the guts to stand up and say, you're right. It's not me. It's a study. I mean, this is not about me. This is about objective reality. But they're so weak that they don't want to stand up and say, you know what, you're right. This is true. Here's the documentation to back it up, because they all want to CYA. They all want to cover themselves. And, it isn't me. I had to do it because so-and-so says so, because they can't think on their own. And it really irks me because I got a hold of one of the top guys, and he just went on and just mealy-mouthed the whole thing. Well, we don't like gold. Well, I don't care what your opinion is. The facts are that you need it. You need it in the portfolio. You need to protect your people. You need to do your job.
And you can do your job by going to the Morgan Report. David, quickly, what the website for those who want to first sign up for the free newsletter that you send out, and then secondly, to get deeper into this, the paid service.
Yeah, the best way to get there is just themorganreport.com, all one word, themorganreport.com. Get our free weekly. It's a once-a-week letter, so it doesn't just jam your email box. It's a quick read. Usually it's an interview or a question of the week. And then for those that really want to get into money, metals, and mining and find out how to really do well in the upcoming financial debacle, can get over to the right-hand side of the website. There's 3 levels of service: a basic, an intermediate, and an advanced service.
David, it's always a pleasure, my friend. It goes by so quickly. Thank you very much for your time today.
My pleasure. Thank you.
You too. Hey, this is Alan Butler. We will be joined by Mark Thornton on the other side of the break. Mark is with the Mises Institute. Always a good guest, as David is, who we just spoke with. This is Alan Butler, Butler on Business, and we'll be back in just a couple of minutes. So hang in there, and we will see you shortly.